Hey, hello everyone. And for those just joining us here today, welcome to Advanced Risk Management for Soft Commodities. Again, if you're just timing in, please know that we have a question and answer function at the bottom of your screen where you can submit questions to panelists here today, and we'll do our best to address those questions accordingly. So coming into our agenda for today, my name is Craig Haymaker. I'll be the moderator for today's webinar. And in a moment here, you'll be joined by Ben van der Laan with DycoTrade CTRM, as well as Richard Cornielje with KYOS, Multi-Commodity Risk Solution, who's going to speak to us about the role of data and also advanced risk metrics, respectively. And then I'll be able to bring us home in the end to discuss translating data and risk analytics into earnings performance. Okay, we have a jam-packed seminar, a lot of things to go through today. So we're going to go through a little bit quickly, all right? So now let's get into why we're talking about advanced risk management here today. Well, the difference in today's business environment is because the expectations around risk management have changed. And senior leadership and boards of directors, really across industries, across entities, and even at an individual level, they're all striking a different tone. In other words, it's not good enough today to say, okay, well, I don't know where commodities prices are going. I don't have a crystal ball. And it's also not good enough to say, no one saw this happening, the significant impact that we incurred, this big risk event, nobody saw it coming, okay? We need to have flexible frameworks and process in place to be able to manage risks accordingly. We need to have an orientation around how risk might affect our business and where we think the markets may go. So that leads us to discussions about strategy and risk, and also responsibilities across an organization. So if we stare here at the top of the screen and we think about the responsibilities of senior leaders, it is the responsibility of the board to establish the enterprise's risk appetite. As we know, they alongside senior management need to determine what the strategic objectives are going to be, and the risks that are introduced to the enterprise along the way that may impede us from achieving those strategic objectives, okay? But the amount of risk that we're willing to tolerate to pursue strategy, that is established at the highest levels of the organization, as well as establishing a risk management policy that is going to put the guardrails around these programs as well. And then it is up to everybody else, what we're calling here the rank and file, right? So middle management and below, all the way down to staff level, to understand and appreciate what the objectives are, to know these policies inside and out, and to execute in accordance with these policies, okay? Only through this are we going to be able to carry out the objectives of the business. So where do we begin? First and foremost, we need to articulate what risk means to the enterprise. Is risk simply the variability in our commodity price inputs? Or is it prices rising above a certain level or below a certain level as we think about budgets? That needs to be very clearly defined across the organization. And then, of course, our risk management objectives will follow suit. Once we understand our targets and our risk management objectives, then we can start to say, okay, this is our hedging strategy. This is what we are going to do to mitigate and address those risks, okay? And then, of course, to help execute that hedging strategy, we are going to have certain hedging tools that we're going to use to meet those needs, right? Be they something more vanilla, more simple, like futures and options, or maybe something a little more complicated, getting into swaps and accumulators and triggers and those types of instruments. That needs to be very clearly defined, and it needs to be understood what tools the organization can use to execute hedging strategy, and that should be laid out in that risk management policy that I mentioned a moment ago, okay? So within this policy, we're going to create and assign responsibility. The roles and responsibilities of the individuals tasked with fulfilling that policy need to be clearly laid out so that there's no confusion. And then being able to execute on that strategy requires monitoring and reporting. Things like risk scorecards that tell senior leadership, okay, this program, right, the strategy is doing what we expect it to do. We're hedging and reducing risk in a manner that is consistent with expectation, okay? And then, of course, all along the way, we have process, control, and technology to assist us with that, okay? Process and control to help ensure that the data that we're using has integrity, process and control to ensure that the reporting outputs, again, are consistent with that expectation, and that the amounts that we're seeing are complete and accurate. And then what key stakeholders are going to look at the end of the day is our accounting and financial reports, right? That measures and shows the health of the enterprise. So between those risk scorecards and these accounting and financial reporting outputs, those are the things that senior leadership is going to look at as measurables to ensure that everyone is doing what they're supposed to be doing, okay? So all of these things will lead us towards our ultimate goal, which is really earnings optimization and ensuring that our business does not fall victim to the peaks and valleys that the market brings to it, okay? So diving into soft commodities here today, of course, there are many different asset classes, but we're going to be focused primarily on cocoa, coffee, and sugar, which we'll be referencing throughout the presentation, okay? But in order to better understand these commodities and their asset classes, we need to understand the various supply chains in which they operate. Now, the supply chains that you see before you here, okay, kind of moving left to right from creation to eventual consumption, these are all very high level. We could go very granular. But what we're trying to convey to our audience here today is that there are striking similarities across these asset classes, right? The farming, right? The cultivation and harvesting of these products, and then getting into the processing and refinement, okay? But understand too, that ultimately these asset classes, these commodities, as they're created, they need to make their way to the eventual consumer, right? Whether that's retail, food service, and so on, roasteries. Okay, so in that vein, we have producers, traders, and consumers. Each of these different groups has a different view on risk and how they perceive commodity prices. And as a result, what their strategy will inform them is in terms of what is the best decision for their business, okay? Again, the pursuit of strategic objectives gives rise to risk. So as we think about these different groups, right, we have producers, which care deeply for the eventual sales price of their commodities product, right? Their intention, their orientation is to sell at higher prices so that they can cover their operating costs to produce those very things. If prices are really, really low and fall through the bottom, they're not going to be so inclined to sell, at least not with the same amount of volume as they were before. And because of that, they will have produced less, okay? On the consumer side, it's the opposite. Consumers are seeking prices that are less than what the market's showing, or their intention and hope is that prices will continue to drop. So their orientation is very much in a price decline scenario because they're trying to maximize their budgets as well, okay? Again, every party here is trying to maximize its own utility. And that leads us to traders there at the bottom. For traders, it's all about the margin, ensuring that the price point at which they sell exceeds the price point at which they're buying. But because markets are moving, it makes that scenario very challenging. So we thought today we would focus on traders and their concerns, their issues, and their risks as it relates to their view in the marketplace, okay? So for traders, to appease their customers, they want to offer flexible pricing and flexible contracting. So they might allow their customers, be they on the purchase side, right, the producers that they're purchasing from, or on the consumer side, you know, the entities that they're selling to, they'll give them flexibility. They'll say, okay, do you want to purchase at spot prices in the marketplace, or do you want to lock in a fixed price out 6, 9, 12 months, whatever the case may be? And oh, by the way, what's common in some of these industries as well is to execute a price to be fixed contract, okay? So a producer might go to a trader, right? And that could be an exporter or importer, and say, you know, I'd really like to sell you goods in 6 months, in 9 months, but I don't want to lock in that price yet. I don't want to lock in that underlying futures price and differential basis. okay? Time goes by, say 3 months. Then that customer calls up the trader and says, okay, I'm ready to fix that price. Traders want to give their customers flexibility to do that. But in order to do that, the trader needs to be comfortable operating in the capital markets, buying and selling derivatives to be able to offer those prices, right? So for example, if I'm a trader and I get that call to fix the contract, at that moment, I might sell short in the marketplace, okay? So being able to offer that flexibility and to ensure that that margin that I'm locking in is what I want it to be, it takes a lot of effort. And it takes a lot of really critical data to be able to do that well and on a consistent basis. Okay, so again, from a trader's perspective, the paradigm is very simple. If you have buyers and sellers coming to the table at the same time for the same product and for the same delivery period. But this is often not the case, right? What typically happens is that traders, depending upon where prices are, might need to purchase more product in advance and then store more in inventory or warehouse it. Or they may need to hold less in higher price environments and maybe purchase more at spot prices on demand, just in time, okay? It's not easy to navigate, but we need data to do this, okay? So again, what traders need to think about are 3 primary things: the data on our inventory turnover, okay? And how their customers have responded, how they've behaved in different price environments. And again, when I say customers for traders, I mean both producers that they're purchasing from and consumers that they're selling to, okay? Not only that, it's critical that traders have a view on where coffee prices may go and the potential impact that those prices may have on their net position. So when I say net position, after I consider the entirety of the trader's exposures, buy side, sell side, inventory, and hedges and derivatives, am I net short to the market? Am I net long to the market? Is that where I want to be? Well, I can only answer that question if I have a view on where prices may go, if I have a position, an orientation as to where those prices will be, okay? And last but not least, again, we have to think about our friends, the accountants, okay? And accounting and cash flow considerations that reflect exactly the operational and hedging strategy of the enterprise. In other words, earnings optimization, earnings performance that reflects the economics of the business in a manner we desire, right? That's what we're seeking. So that leads us to our friends at DycoTrade, and now I'm going to hand it off to Ben van der Laan, who's going to take us through the role of data and its importance for advanced risk management.
Thank you, Greg. Let me share my screen as well. After your beautiful introduction, can you confirm that you see my screen, because then everybody else will see it too? Do you see me?
I was trying to find my unmute button. Yes, Ben, I see it. It looks great.
You're so fast with muting and
fantastic.
unmuting. Okay, thank you.
Thank you.
Okay. Welcome from my side as well, of course. Just a quick introduction on DycoTrade. DycoTrade is a commodity trader risk management solution. We are a Microsoft ISV. That means we're an independent software vendor. We build our own solution on top of the Microsoft software. And for the past 20 years, we've been working on our what we call multi-commodity solution that we're showing you a little bit of a peek preview today. It's important to tell you that it is embedded in Microsoft Dynamics 365 ERP, meaning it's built in coherence with Microsoft. We take the standard ERP functionality from Microsoft, all the finance, logistics, etc., and we add our own commodity trade specific functionality on top of that. So there's no integration between the two. We are the same product. We're embedded in the same, and it's a cloud solution. It's built on Microsoft Azure, meaning it's hosted by Microsoft, and having no integration with the ERP, but being an embedded solution is of course a very, very large advantage. I'll take you quickly through a look and feel, and then we'll talk about position management. What is it that the trader is looking at, and what information, what data does he have at his fingertips? As Greg already mentioned, he needs to have the right data. The trader wants to act fast. It has to be complete. It has to be flexible, and he wants to fix his contracts when when the time is right. So we'll look at contract creation, and after the contract, we'll hand over to KYOS and see what KYOS does with all the information that we put into the system. So just quick look and feel. It's a Microsoft solution, so it means a very familiar user interface to most users, and being familiar with Office and Outlook, as most of us are, you'll find your way through DycoTrade very easily. It also means that the system can be accessed through any modern web browser, desktop PC, Mac, tablet, mobile phone, and on top of that, we have native apps for Apple and Android ecosystems, so also available on your smartphone. The homepage, as you see it here, works with dashboards, and the dashboards are related to the user's role. So depending on whether it's a trader logging in, logistics operator, risk management, accounting representative, they will all have their own dashboard. And the dashboard is actually helping you where to focus and where to spend your time on. Another advantage of being web-based is that, for example, you can use multiple screens at the same time. So you don't have to switch between windows. In this example, you see the Forex exposure of the sales contracts on the left, and we can just be issuing a new FX contracts to mitigate risk on the right. I don't have to go back and forth. I can just have two screens at the same time, two sessions even at the same time, and working in both. Going back to dashboards, one example is the trading dashboard. Of course, we're talking about traders today, which shows me the open sales contracts with prices to be fixed, and in this example, cocoa not delivered. So indicated contracts which require the attention of the trader, because the system is helping you to show you where to spend your time on. Of course, these dashboards are fully customizable to the role, but even to the user. So we have a few examples. Here you have another one, also a trader dashboard, where the trader likes to have a graphic representation of the buy and sell quantities per commodity at hand. Or, for example, this one, where the customer wanted to have the positions at the bottom of the screen, easily all your information accessible at hand, quickly, no searching, and you can act from that data right away. Other options are, for example, to embed third-party websites. Here you see that we have a Reuters website within DycoTrade, directly accessible in DycoTrade. So as a trader, you can have a quick look, latest prices for sugar, cocoa, coffee. Here it is one screen. Of course, we can make it smaller and we can have our own position next to it, just as works best for a specific user. What we see with a number of our customers is, for example, an integration with TradeLens. Maybe you're familiar with the solution. TradeLens is showing you the latest position of your container, your truck, your vessel, etc. But it's showing the data that is pulled from DycoTrade. And when you hover over a specific vessel or port of truck, you get the details of that shipment. In this case, it's a vessel moving from Philadelphia to London, and a link is provided so you can get directly into TradeLens from DycoTrade to see the more finer details of this shipment. Using workflows, also because it's standard Microsoft functionality, traders can approve or reject, or senior traders or managers can approve or reject new deals, new proposals, timesheets, expense reports, of course, in DycoTrade directly, but also through email or even using a 365 app on your smartphone while traveling. We know that our audience is on the road a lot. No need to be disconnected from your organization and from the trading process that's going on and back home. If we now take the role of a trader coming to work, of course we take our coffee in the morning. We're talking about coffee today, so let's not skip that one. And we open up position management dashboard, and we see our positions, and we see where we need to take action on the data gathered from a variety of data sources throughout the system. So it can be open purchases, sales, inventory levels, market prices, etc. They're all combined and they're all coming together here. At the blink of an eye, position per product group is visible, and using the details button, we can drill down further into position per product. As you see, colors and icons are indicated potential areas of attention. A short position, a long position, overselling, they're all shown to alert the user to further investigate these items. Of course, this is all configurable, so which areas of interest you would need is completely configurable. This is more a data approach, a list approach of data, but we can also use analytic mode of the dashboard, and then we're going to use Power BI. Power BI is Microsoft reporting tool, and that enables us to make reports like this, because then we're visualizing the same data, but in a very user-friendly way. Then that's crucial. We need to enable the user to see effects and trends in the numbers quite easily, because then you can act upon it. And that's where Microsoft BI, Power BI comes in. Extremely powerful at visualizing data. And here you see the product position throughout the month, a large short position in February, we can see there, and we can drill into that by clicking on this large red bar. Now we can see that the short position is actually created by two product groups, in this case CEC, commodity exchange contracts, futures and options, and grains. And by drilling into the futures position, we can expand that part of the table. And then our future cells for the product coffee and white sugar, they are causing the large short position. So as you can see here, of course, we want to go one step deeper because we want to know which contracts are part of that short position. So you can drill down even further. And then apparently our future cells for coffee and white sugar are causing this large short position. If you want to see which contracts are part of the short position, you can go even further down. Here you go to contract details such as contract number, product specs, quantities, etc., possible prices and value of the contract. This position that we have, we can of course slice in a number of ways. One that we've been using with a lot of customers is geographical map view. So on the left, you see the locations where we buy the goods. On the right, we see the locations of the selling locations. And by clicking any of these circles on the map, products, traders, all other items on the report are filtered into the corresponding data. All these views are near real-time and interactive. So clicking any of these circles on the map gets you to the details of that specific transaction or contract. One important thing to note is that this dashboard is not just for retrieving data, but we can also create new contracts. We can act upon the data that we see, the things that the system tells us. And it can be new contracts, physical contracts, future contracts directly from the dashboard. And we can take our corrective action for a short or long position. To do this, we use the new button at the top, and we choose the type of contract we want to create. Assuming we have the correct security privileges, of course, that we're allowed to do this. But looking at the cocoa position here, it looks like we're oversold. There's the red background for the sell quantity column, and we need to create a purchase future to act on this. From here, we can do a number of transactions. We get a new future purchase sales contract or a new customer to sell some inventory to. And directly from the dashboard, we can create a future contract to buy cocoa. We can add the details as required, and the position is updated accordingly. Now we see that the buy quantity for the cocoa product group has been increased. The red background for the sell quantity has been changed to yellow because it's a smaller short position. We're still short, but we're not in a danger zone anymore. But the trader spots something else. Here he also sees a large short position of Arabica coffee for the next year. So he decides to create a new physical purchase contract spread out over 2023. And directly from this position management dashboard, we can create a purchase contract. 30 million pounds of coffee beans, Arabica, shipped from Ghana to Rotterdam throughout 2023. The contract has been created. Monthly deliveries has been set up. Confirmation can be sent out to the supplier. So basically, as a trader, we did what we had to do. But then the real fun starts, and we're slowly moving to the part of the presentation of KYOS to present their advanced risk management, because then it's also about cash flow, value at risk, cash flow at risk, based on the coffee contract that we just created. So now we're going to learn from today, and we're going to predict the future, and that's the handover. And in the background, it's a seamless handover of data, of course. Here in the presentation, it will be me dropping off and Richard Cornielje of KYOS sharing his screen. But I think the floor is yours, Richard.
Thank you very much, Ben. And if you can confirm that you can see my screen, then I'm pretty sure that everybody can see it as well.
I do.
Okay, that's good.
Looks great.
Fantastic. I think we already heard quite some interesting stories, as well as from Craig, as we call him in the Netherlands, Arjan, and from Ben. And the next step, of course, is what can we do with the data? But first, of course, we need to pick up the data. And I think, like some famous people might mention, that it's all about you have to know what you're doing, either from the products, but of course also from your positions. And this is the data that is stored in the DycoTrade system. And from there, they have the ability, of course, to calculate the mark-to-market. What is the current value of the futures and the swaps that are stored in the platform? And from here, we start looking into the future. I don't have a glass ball. I'm in this particular markets for almost 35 years. Some people ask me, Richard, what do you think? And my answer is always, if I knew, I would not be talking to you. But what we do, and what we do well at KYOS, is, for example, calculating and valuing different kind of structures, like the derivatives, option structures. And Craig already mentioned, for example, the word accumulators, quite often used in this particular area of markets. We perform stress testing. We calculate short-term risks, called VAR. And then I think I also noticed one of the questions was about VAR. Why are people still paying attention to VAR? And maybe I can explain that a little bit during this particular presentation. But for the longer term, especially from a CFO or CPO, they really look far more at the long-term side of the curve, and we call that cash flow at risk. So short-term, more focused on traders, long-term, more focused on procurement teams, and also from a CFO perspective, what can happen with our cash flow on the longer term. We combine the data of DycoTrade, the physical flows, the financial hedges, into price analytical functions. We create reports in the platform for the CPO, the CFO, head of trading, risk, or treasury. I think also treasury has to be mentioned, because step by step they're getting more involved. Especially in the last year, of course, we saw enormous price changes that opened the eyes of many people in this particular market. And of course, we all know hindsight is a wonderful thing. And we try to help you to look forward. But we need the data. We need the flows. We need the financial hedges. We need the physical data. And we perform price data analytical functions. Initially, we need the ledger. The general ledger of the data stored in, for example, in the DycoTrade platform, with physical contracts, maybe with a fixed price, or physical contracts with an index, because you want to calculate what is your underlying exposure in the end, like Ben mentioned with the trader and his position. We need all the financial futures. We need the swaps. We can take the data from the EP platform, like DycoTrade. We can also receive those tickets from the broker. If you do multiple trades, if you do one trade, you can enter them into the system. If you do a couple of hundred trades on a daily basis or weekly basis, you might want to push those trades automatically into the platform. And besides futures and swaps, you can also, of course, store options, calls, the puts, all the different structures that you want to store in the platform like this. Like Ben said, we have a base case also to explain the concept of VAR and the concept of cash flow at risk. So the base case is that we have a specific need. We need a source, or we have a position of coffee, Arabica, spread out during the year, physical from Jan to December, different kind of volumes, but they are connected to the well-known futures, the March, May, July, September, December future. In this particular example, we made sure that the underlying exposure at the moment of the calculation is still the same as the physical. And of course, we all know that's not always the case in real life situations, but for the easiness to follow the concept of this particular calculation, I think it's easier just to show that the underlying exposure is the same as the physical exposure. And like Craig said in the beginning, there is a different view on how people react on exposures. It's not only the role, the trader or procurement or producer, because that's quite obvious. It can also has to do with a bonus and a target. If people have secured their bonuses and it is September, October, and they still have 2 months to go, I know from experience that many traders will say, I keep my head down. I earned my money, I'm in, so I don't take any risk anymore. The other way around, we see as well. If people have lost some money and it is November, December, a couple of weeks before the deadlines, then people have the tendency to take some more risk. And I think this is also important to understand in people don't always act like you expect them to do. It's really depending on what is influencing in the end, the final result. But if we have a base case and we need to define profit or the loss from a risk perspective, we need data. And of course, the easy part is just look at the current market. I made this sheet a couple of days ago, but I think it's still valid. I think we are down a couple of cents on the pound. But 30 million pounds of coffee with the profile that I stored in the platform has a current value of roughly $71.5 million. And Ben and I talked before, and Craig, of course, and we said, okay, it is rather big, but it's also easy when you're a little bit smaller. You can say, well, my OpCo is maybe 10 times smaller. I don't have a position of 30 million, but 3 million. And we also have clients that say, well, 30 million, that's what they have on a monthly basis. Yes, then just multiply your volume by 10. For the VAR calculation, it doesn't really matter. Now we say we have a 30 million pounds exposure for the year 2023, a bit diversified on the volumes from Jan to December, but the current value is roughly $71.5 million with an average price of 238. But the question, of course, is what can happen? Because when your CFO steps in your office, and maybe you are the CFO, you expect and probably demand from your people a view. What can happen from today to tomorrow, or 10 days, a normal holiday period. But in this situation, it's a view on our to be procured Arabica position in 2023. And it's now Feb, so it's almost 2 years of a whole period. And especially when you have multiple commodities, you have your packaging material, you have sugar, you have cacao, different kind of commodities, then it becomes complex. And then it's difficult just to use your brain. It's difficult to say to your CFO or to the CEO, to the CPO, yes, I'm in this market already for 20 years. I have lots of experience. My gut feeling tells me I should not buy. That's not the message, and that's the same what Craig said in the beginning. With these kind of remarks, it's not enough anymore. Your gut feeling or your experience, we need to combine it. And I don't say that the gut feeling is bad, because I think a gut feeling is some sort of a translation in the brain that you are in this business for 20 years. You read the newspapers, you hear from the Goldman Sachs, the JP Morgans, all that particular information. So it is a translation, but it's difficult to present that on the board level. So we need to do some number crunching. That's what I also did just 2 hours ago. I just looked at, okay, what did I see, for example, for the March 22 future? What did I see from the moment that this future started trading? I think it's April 2019 until a couple of days ago. So on the right-hand side, we see the current forward market. On the left side, we see how this particular future behaved. Yes, long time, quite stable between the 100, 120, 150. And then we all know what happened in the last couple of months. But how does this help us to say anything about the year 2023? That's the difficult part. But when I trained young people in the dealing room, and also when I started, people said to me, Richard, here are the numbers, start reading, start making some calculations. What is the high that you have seen? And with the high, I mean the highest price change in one single day. And I did this just before the presentation. And I noticed that the highest price change on one single day was 18 cents on the pound. The highest price fall was 17 cents per pound. In the average of almost 700 trading days, so from April 2019 until yesterday, the average price change is 2.12 cents on the pound. And this kind of information starts helping you to use VAR. So what can happen in one single day? And then we have the ability to translate it into a figure. Because yes, we can go to the casino. Yes, we can make all kinds of calculations. The question is, what is going to happen? And mind you, we can go to the casino, yes, but the casino makes all the calculations on the right-hand side because they know they will always make money. There will be a day that they will lose some money, yes, but in general, on the other 364 days, they will make a lot of money. Sometimes, if I need to explain the concept of VAR to a CEO, and he has many things on his plate, I'll explain it with this particular picture. It's an apple tree, and when we don't pick them, they will fall. Some will fall to the left, some will fall to the right, but most of them will fall just below the tree. Depending on the surface, depending on the wind direction, you can argue, okay, but maybe they will fall more to the left or to the right. Yes, but in general, we can say this is, as we call it, a normal distribution. But of course, in this market, there are price differentials. We have coffee, we have physical coffee, we have fundamental elements. So it's not always that easy. So we use also Monte Carlo simulations, as we call it. These simulations are normally used when we have longer horizons, when the exposure is complex or there is more uncertainty. That helps us to define the profit or the loss, but it helps us to calculate the risk. So if we come back to the example of the value at risk for the 30 million pounds, I need to calculate my volatility. If I have multiple exposures, I need to calculate my correlation. And based upon that data, I start having some view of, okay, what is a realistic bandwidth? So not the direction. Again, if I knew that, we would not be talking to each other here. But we're quite good at calculating a realistic bandwidth. Then we have a bandwidth of the March or the May 22 or 23 or 24 futures. What is a realistic bandwidth for the coming months or coming weeks or coming years? And based upon that data, we can bring VAR into practice. We know the base case, 30 million pounds. We know the current value, 71.5. And we have done some number crunching. And like I said, the high and the low, I've seen the highest price rise with 18 cents on the pound. I know that the normal daily average is 2. So probably it will be somewhere in the middle. And if I calculate it with the VAR models that we have, I can directly calculate, okay, based upon this exposure, a normal movement with 95% certainty, I can say that the change in one single day will not be bigger than 2.3 million US dollars. So 30 million pound exposure with a current value of 71.5 million based upon the current volatilities. This is the answer that we are looking for. And this is how we can use VAR in practice. Because now we can divide the 2.3 million based upon the 30 million exposure. So we know that roughly 7.7 cents on the pound, that is my VAR. So with 95% certainty from a price change, it will not be more than 7.7 cents on the pound, up or down. And it's indeed between the average, 2.12, and the high that we have seen. So it's also, it makes sense. So this is a way how to use VAR in practice. And I also use this example, for example, especially on the CFO level, CEO level, because for them, they want to have some sort of visualization and an understanding. If they go on a holiday, for example, on 10 days, I know, because I'm doing these kind of calculations 100 times per year, that if a 1 day VAR is 2.3 million, then I know that a 10-day VAR, based upon this volatility between 20 and 30%, will be around the 7.5 million US dollars. I don't have to calculate it, I just know it. But then I can say to the CEO that if you go on a holiday for 10 days, I know that your position, the 30 million pound, the 71 million US dollars at this moment in time, will not change with more than 7.5 million US dollars up or down in 10 days. And then still difficult for them to understand, but then I say the 95% certainty, in fact, means that if I make these calculations for 20 of your holidays for the next coming years, 19 times I will be right with this particular calculation, because 19 out of 20, that is 95%. I think that's also helping clients to understand and bring theoretical models into practice. How can you explain it? How can you use it? So use the data, use the volumes, and make the calculation. But now we are the CFO, and the CFO says, well, that's nice. 1 day, 10 days, that's nice information, but we are having a position for the year 2023. What should we do? Should we hedge, yes or no? My colleagues, the competitors are hedging, or maybe they're not hedging. Most clients talk to each other, so they know some information of each other. Now they have to look ahead. And then of course the story is, okay, what is risk? And of course, this is just a teaser. I mean, for me, it's a risk. I would not do it. I would not take that man's head in my mouth. But for him, it's not a risk. He has the guts to put his mouth over the head of this particular man, somewhere probably in Asia, maybe the US, because we have some devils over there. And of course, this is just a joke. But we also, when I started in the dealing room, we had people like this. Of course, not Truman, because I think he died a couple of years. I think I was 9 or 10 years old. But it's more about the type. A severe look, tie, and they have remarks like this. Like Craig said in the beginning, if you can't stand the heat, get out of the kitchen, stay out of the kitchen. But that's not enough. It doesn't help being a bully. You need to have explanations. You want to go to your CEO or your CFO and say, well, at the moment, yes, we can hedge for 71.5. Given the risk interval that we have calculated, there is a possibility that we end up in the 5% worst case scenarios, paying more than 112 million. So from a risk perspective, the risk is 41 million. This is what you want to explain, combined with your gut feeling, combined with your experience, because you're in this market for 20 years, but now also supported by these kind of calculations, automated calculations. It helps you riding the bull. It doesn't change markets. Markets will go up and down. Sometimes you're wrong, because yes, markets can also go the opposite. And maybe you should not have hedged and keep this position fully open, because in the end you would have paid maybe 44 million. But from a risk perspective, you look at, in this example, the downside. And we know that, of course, many clients, like also Ben explained, you use physical price agreements, you use the swaps and the futures, you use accumulators. And all these structures help you to make the bandwidth smaller, the percentage higher, more certainty, less exposure. So you have the feeling that you are in control. Prices will go up and down, yes, but you have the feeling that you have the steering wheel in your hands. One thing that I wanted to show to you is, for example, accumulators. And of course, also in sake of the time, we are not going to discuss about accumulators, but I think when we send this presentation around, you can go to the website of ADM. And I know also Cargill is putting this in the market, Cargill Financial Services, JP Morgan, Goldman Sachs, Barclays, all the big banks. So it's not something that we say go to ADM, but it's something that we see. And I think it's really important for you to understand that you can argue if this is a hedge. And that's why I really wanted to take this particular slide, present it to you, and maybe you can ask questions afterwards. Also email us or Ben or Craig with questions. But we as a company, as KYOS, we also make valuations of these kind of structures. Also before you enter the deal. And I think that's also important. Not only when you have executed a deal, but you can also evaluate these kind of deals before entering into a trade. And of course, when you're a small company, just running one opco, but we also have big companies, maybe with 25 different opcos around the world, or 50 different kind of opcos. The whole concept of gathering data from, example, an ERP platform, well-known like DycoTrade. DycoTrade, for us, it doesn't really matter. As an umbrella, we can pick up all those different kind of informations, either from a real system, but we also know that some clients say, well, we have a small entity in China or in Peru or in Chile, and they don't have yet a big ERP platform. They use Excel. Of course, we can pick up those files as well. And I think also that's my last message for this particular presentation. With these kind of systems, you get consistency, transparency. And of course, I'm not here to tell you about the future, but I want you to be prepared. And that was the message for today that I wanted to give to you. Craig, I would like to give the word back to you.
Richard, thank you so much. And Ben, really nice job as well. I'll share my screen here. I know we're out of time, folks. Thanks for being patient with us, but I figured we'd wrap up our last comments here and going through our slide deck, because really it's about taking these concepts and putting them into action, taking data, taking risk analysis, and ensuring that we are getting the outcomes we desire, right? So what I said in the beginning, that it was critical for traders to use data to understand how their customers have behaved historically in price up or price down scenarios. We can use data in DycoTrade and Power BI to visualize this very thing. So on the right-hand side of the screen, we can see how our customers hypothetically have behaved in the past as it relates to the producers and the purchases that we've been making on that side. We can see the price of Arabica in the green and the volume, the quantity of bags purchased in the gray. So we see a positive trend there. Now on the consumer side, in terms of how much Arabica has been sold in this hypothetical scenario, and as well, you might imagine that there's an inverse relationship between price increases and bags sold. Understanding this dynamic allows us to optimize that inventory turnover, right? Keep less in storage and warehousing, and ensure that we're turning these products over as quickly as possible, and therefore enhancing the liquidity of the business, right? Where are coffee prices going? Participants in the commodities markets must have an orientation on market direction or some idea, right, within a reasonable tolerance, as far as what Richard was mentioning, of where prices could go. And again, considering net position, fixed purchases, floating purchases, fixed and floating sales, current inventory levels and their value, and then of course our hedging positions or derivative book. And again, we can take a view into where futures prices are trading at the moment, because at any given time, the futures forward curve is an indication of market consensus. This is where the markets think prices are going, which is why they're trading at these levels, okay? And then of course, Monte Carlo, VAR, price simulations, critically important tools to have in the tool belt to be able to inform decision-making about price, potential price movements, I should say, Okay. And then lastly, of course, we need to consider accounting and financial reporting. The best way to optimize accounting and financial reporting outcomes is to take advantage of hedge accounting guidance. So internationally, we're talking about IFRS 9. Here in the US, we're talking about ASC topic 815. But what this speaks to is reducing earnings volatility, okay, and maximizing earnings outcomes by taking advantage of preferential accounting treatment using hedge accounting. So what does this do? It allows us to defer the impact to our earnings of our hedging positions, of our derivative positions, right? So we can time those gains and losses to offset with the things that we're hedging, right? Time that short futures position in a manner to offset our long position on the purchase side, and so on, right? Swaps, accumulators, futures, options, whatever the case may be, being able to time those gains and losses in a manner to achieve that offset in earnings is crucial. So here is what our earnings may look like without hedge accounting, without IFRS 9. And here is what they look like with hedge accounting, right? So you can see clearly the positive outcome, which is what hedgers, risk managers, and traders more broadly are seeking as it relates to their business, and showing key stakeholders, okay, we are doing what we're supposed to be doing here. So taking all those things into consideration, translating data and risk analysis into earnings outcomes, earnings performance is of critical importance. Folks, thank you so much for your time today. I know we took more of it than we had anticipated, but again, we welcome your questions and appreciate your perspective here. So please reach out to us if you have anything you'd like to discuss. Ben, Richard, again, really nice job. Thank you so much, everyone, and take care.